If you have money in stock, ETFs, mutual funds, or crypto, the next few weeks decide whether you keep more of your gains or hand a big chunk to the IRS. This is the moment for year-end investing tax planning. We are down to the final stretch of 2025, just 2 months left to make moves that directly shape your April tax bill. In this video, I will walk you through everything investors need to do before December 31st, 2025 to lock in deductions, minimize taxable gain, and clean up crypto reporting before the IRS comes knocking in 2026. This video is divided into 7 clear parts so you always know where we are and how each part builds on the next. So part 1, what tax loss harvesting really does for you. Part 2, step-by-step execution. Part 3, the watch safe rules and how to avoid it. Part 4, crypto tax rule and the 1099 DA reporting cycle for 2025. Part 5, strategic gain harvesting and mutual fund traps. Part 6, a year-end investor checklist and estimated payments. Part 7, practical example and some takeaway for you. So by the end, you will know exactly what to do in December. So your 2025 returns look the way you plan. Let's get started. Tax loss harvesting means selling investments that are down, so those realized losses offset gains you have already realized in 2025. If your losses exceed your gains for the year, you can deduct up to $3,000 against ordinary income in 2025 and carry the rest forward indefinitely. So this rule remains unchanged for 2025. Who benefits the most? Anyone who realized gain this year, like selling appreciated stocks, a fund, business equity, or other investments. If you expect capital gain tax in April, harvesting losses now reduce that bill before you file. Why does this matter? Every dollar of capital loss offsets a dollar of capital gain. That is direct tax saving. And when you do it before December 31st, the math counts for 2025 tax year. Let's move on to our part 2, how to do it step by step, how to do it correctly. Now the practical on how to do this, why there's still time. So step 1, you want to pull report. So you want to download the realized and unrealized gain loss report for 2025 from each brokerage account and custodial account. Step 2, you want to sort for opportunities, like screen holding that was down more than 10% or focus on position you don't plan to hold long term. So the 10% is just arbitrary. You can choose a percentage that for the stock that was down that you are comfortable with, like you want to get rid of anything that's down like more than 40% or 50%. This is the number that you choose for yourself. Step 3, target specific lot. If you can identify lots, sell the highest basis lot to maximize harvested losses before keeping position you want. Step 4, place sales by December 31st. The trade date determines the tax year, so don't rely on settlement. Step 5, reinvest immediately to maintain exposure. So buy a similar but not substantially identical fund or ETF, because if you buy something, you buy the same stock back within 30 days, that's called wash sale. So when you do a wash sale, then the loss is disallowed. So if you was gonna maintain the same or similar portfolio, then you want to buy something similar risk or similar exposure, but not the exact same stock or mutual fund that you just sold. Step 6, document every move. So you want to record ticker, lot ID, cost basis, sell date, trade date, proceeds, risk management ticker, and rationale. Step 7, rerun the screen mid-December. Market change, do a second pass around December 12 to 18 and capture a late opportunity. Let me share an example to make this clearer. So I'll call this a hypothetical scenario so you can follow the step without being a real client story. So example A, a hypothetical business owner in Honolulu, they realized 100K of long-term gain earlier in 2025. By October, they had 32,000 of unrealized losses across several positions. So follow the step above. They sold targeted lot on October 28, rotate into similar exposure with a different index fund from another issuer and documented everything. Net gain dropped materially and they remain invested. That's the execution path. So download screen sell by trade day replaced with non-identical exposure and document. Part 3, the wash sale rule and how to avoid it. This next part is critical because a careless repurchase can nullify your deduction. So the wash sell concept. If you sell a security at a loss and buy the same or substantially identical security within 30 days before or after the sale, the loss is disallowed for now and added to the basis of the new shares. So think of it as a 61 window. So 30 days before and before the sale, 30 days after the sale. Here is practical rules for you to maintain a 31-day buffer before repurchasing the same ticker. Always use different index funds or different issuers to keep exposure without being substantially identical. For example, sell an S&P 500 ETF from issue A and buy a total market ETF from issue B. Coordinate across all accounts, so your taxable account, your spouse account, and IRA, because purchases in any of those can trigger a wash sale. Turn off DRIP, which is dividend reinvestment on tickers you plan to harvest for at least 35 days to avoid automatic repurchases. Hypothetical example B, a scenario to illustrate the trap. A couple in Seattle saw a tech ETF at a loss in a taxable account, but unknowingly their spouse retirement account brought the same ETF within 2 weeks. Because the IRA purchase disallowed the loss and added basis to the replacement shares, the couple effectively lost immediate deduction. The fix is to coordinate trade calendars and disable or reinvest across linked account during the buffer window. Some important nuance for you, a wash sale doesn't erase the loss forever. It gets added to the basis of replacement shares, but it removes the current year benefit. If the replacement is an IRA, the loss can be lost permanently. So you want to avoid that. So let's move on to part 4, crypto tax rules and the 1099-DA reporting cycle for 2025. Crypto has its own set of rules and obligations for 2025, and a big change is reported. Some key points for you for 2025, crypto is treated as property. The wash sale rule does not apply to crypto in 2025. You can sell a coin for a loss and immediately rebuy the same coin. Wash sale restrictions for security don't apply here. However, this creates market risk on re-entry, so proceed cautiously. New reporting for 2025 activity, exchanges will issue Form 1099-DA in early 2026. Brokers may not report cost based on all transactions in 2025, so you must keep your own records for now. What to do this month step by step. Want to export an Excel file or CSVs from every exchange wallet for all 2025 transactions, which means buy, sell, and swaps, transfer, staking rewards, and airdrops. 2. You want to reconcile transfer across wallets so you preserve cost basis when assets move between custodians. 3. Run a realized gain loss report for 2025 and reconcile it to your bank records. 4. Save the Excel file CSVs and screenshots in a label folder for your CPA. Let's look at our example C, founder token activity. Imagine a founder based in Austin who realized 85K of equity gain in 25 and had 41K of crypto losses. They sold the crypto loss position in November and reported immediately because wash sale didn't apply. They reported all wallet CSVs, fixed 2 missing transfer records by matching bank wire and reduced their net 2025 gain substantially while ensuring records would align with the forthcoming 1099-DA. A reminder for you, documentation now prevents headaches when 1089 arrives in February 2026. Now let's look at part 5, strategic gain harvesting and mutual fund distribution traps. So last is one side of the story, sometimes harvesting gains in the right place. When to harvest gains. If your 2025 taxable income is unusually low, you might still be in the 0% long-term capital gain bracket. So in that window, you can realize gain up to that threshold with little or no federal tax and reset your cost basis higher for future sales. Some step-by-step gain harvesting plan for you. 1. Estimate your tax year 2025 taxable income today. 2. Determine how much long-term gain you can realize while staying in the 0% long-term capital gain bracket. 3. Use specific lot sale to realize just enough gain to fill that window, no more. Some mutual fund distribution, many funds pay out capital gains in December. If you own on the record date, the distribution is taxable to you even if it is reinvested. If you was planning to exit the fund anyway, sell before the record date, avoid an extra taxable event. Let's look at example D, married filer with a rental sale. So consider a couple who realized 200 grand in long-term gain from selling a rental earlier in 2025. They face imminent mutual fund distribution that would add unexpected taxable income. So by having 75K of losses across other positions and exiting the fund 3 days before their record date, they cut net gains and sidestep a large distribution-driven tax bill. So use gain harvesting carefully. You want to model the number and don't chase short-term timing without documentation. Let's move on to our year-end investor checklist and estimated payment, our part 6. So this is your operational checklist to run between now and December 31st. By December 15th, for realized and unrealized gain and loss reports for 2025 from every taxable account. Identify harvest candidates and replacement tickets. Between December 15th and 31st, execute sales like trade date on or before December 31st is a must. Reinvest it into similar, not substantially identical exposure to avoid rush sales. Export and reconcile all crypto, CSV or Excel file and wallet transfer. Check mutual fund record dates and sell before recording if you are exiting the fund. Now let's look at estimated tax planning. So if 2025 produce large gains, plan your Q4 estimated payment that is due for January 15, 2026. So you can use safe harbor rules, so 100% of prior year or 110% depending on your level of income or project actual and pay accordingly. So if income was lumpy, consider annualized installment method to avoid overpaying early. You can coordinate this with your CPA. And remember, this is safe harbor rule for federal only. For your state, you need to check for your state rules. Another thing you want to do is documentation and control. So you want to turn off drifts on targeted ticker for at least 35 days. Keep a one-page December move sheet like what ticker was sold, replacement ticker, trade date, loss ID, and the Excel file where the Excel file is stored. You want to save all trades confirmation and Excel file in one label folder for 2025. Some bonus practical tip for you. You want to coordinate file accounts purchase in either account can trigger a wax sale. Avoid repurchasing happening ticker inside IRAs during the buffer window. Consider net exposure, so 3.8% loss happening can help managing MAGI. Modify adjusted gross income. If you plan charitable donation or appreciated stock, harvest losses elsewhere to maximize tax efficiency. Let's move on to part 7, some example and some takeaway for you. I will share a few more uh, examples. You can hear the move in context. So let's look at example E, a solo practitioner in San Diego. So this investor realized 48K in gain during 2025 from consulting stock sales. They had 19K of losses available in late October. So by harvesting the right lot in November 22, rotating into alternate index fund, and scheduling an annualized estimated payment, they reduced penalty and kept portfolio exposure intact. Let's look at another example F, the early career household in Denver. So this household faced low 2025 taxable income because of job transitions. They realized 8K of long-term gain within the 0% bracket and use that window to reset basis. Then pair it with a small loss harvest to smooth future tax impact. Let's look at example G, the part-time investor with crypto transfer. So this investor moved coin between exchanges in 21 without preserving transfer records. In November 2025, they reconstructed bases using bank wires and exchange Excel files. Sold loss position where appropriate and reconciled everything before 1099 statement was expected. So the cleanup prevented a lot of mismatches and audit flags for the next tax season. Some final takeaway for you, what to do in the next 72 hours. First, you want to pull your 2025 realized and unrealized report from every account tonight. Two, you want to identify the 3 to 5 harvest candidate and plan replacement tickets. Three, you want to export all crypto into Excel and put them into a backup folder of the transaction. Four, turn off drifts, the automatic reinvestment of your dividend where you plan to harvest. And then 5, schedule a mid-December follow-up to catch late dip or distribution news. If you want tools to make it painless, you can use a capital gain and crypto tracker and year-end tax loss harvesting worksheet on pro reduction. For a structured walkthrough, the 2025 year-end investor planning module is available at accesswisinstitute.com. Close the year with intention, sell the right loser, avoid washout traps, document every crypto move, and so set your estimated payment so you don't get surprised in April. Act before December 31st, 2025, so your realized gain and losses work for you, not against you.